Good morning, everyone. This is Randy McCord here with Chris Hamilton. Sales Tip a Day Consulting is helping me with a webinar. And today's webinar has to do with risk management for business and tax sheltering of retained earnings. As a little background for you, what I want to do is I want to talk about the major tax changes that are going to occur in 2017 and how they relate to the value of permanent life insurance products. In many cases, people are unaware of these changes, mostly because they are known only in the insurance industry. And so I think it's important for business owners to understand what options they have, particularly with corporations that are, they have significant retained earnings either on an annual basis or accumulated earnings. Anyway, I'm just trying to turn off a headset here that I have going on. 1 second, please. There we go. Now, the changes that are going to come in 2016 are a bill called Bill C-43. And the reason for the changes is the current tax exempt rules have been in place since 1982. And so the government's now updating the rules to reflect longer life expectancy in the population. So they're changing how they review the mortality tables that are used to calculate certain formulas that allow for life insurance to be a tax shelter for retained earnings, as an example. And just to make it consistent across the board for all life insurance products and companies, these changes, I'm not going to go into the gory details of the changes. I do have a white paper that I can send you upon request, and the white paper really outlines all of the detailed changes. But just to summarize a few here quickly before we go into the case study, you might want to consider buying permanent life insurance in 2016 and not waiting to 2017 if you're going to use the policy as collateral for a loan, because it will increase the potential tax deductions if you're going to use your policy for a third-party loan from the bank, as an example, and the interest is tax deductible. That could be in the case where the corporation borrows against the policy to buy inventory or buy some capital equipment or something like that, where then the interest could become tax deductible. Better to do that in 2016 than 2017. It can also increase the amount of life insurance proceeds that could be distributed tax-free to shareholders in a private corporation. So again, this is key to one of the things we're talking about today, which is the ability to move corporate dollars tax-free to shareholders via an insurance product. You can move more of that money now than you will be able to after 2017. For universal life insurance particularly, there will be an increase in the amount of money that can be deposited or maximum funded on a tax-exempt basis. And that's really what we're going to talk about today, is how much money can be put into a policy on a tax-free basis, into a universal life policy, to tax shelter those retained earnings in the corporation. And that's going to change drastically come 2017. So reasons for that is you can fund the policy more quickly and you reduce the cost of the life insurance, of course, in addition to having the tax-deferred status of the investments. So things to consider in 2016 are to convert temporary insurance to permanent insurance so that you have the permanent product grandfathered in 2016, because there is a grandfathering clause. The insurance councils and regulatory bodies, Advocates and KLU, both lobby the government hard to make sure that anything in 2016 would be grandfathered. Any benefits or riders that you add to a policy that have to be underwritten, so to increase the amount of coverage, or if you want to add a return of premium rider or some other rider, those are best in 2016 rather than in 2017. So that's just a quick overview of some of the things that are happening. Oh, also in retirement planning, to reduce taxes when withdrawing money from the policy and supplement income, it's better to buy temporary life insurance in 2016, like a term policy to guarantee insurability, then convert the permanent insurance later to reduce taxes on withdrawals. Again, another thing to think about, if you ever are thinking of using permanent insurance as a savings vehicle, better to buy it, even if you just buy a term policy that's convertible this year, you're better off than waiting till 2017. And also, a really, really big item that I can't stress enough, but we're not going to go into today in detail, is if you were going to purchase a prescribed annuity, in other words, a non-registered annuity to create a guaranteed income, the tax changes are going to severely affect the tax consequences of the prescribed annuity. Prescribed annuities spread out the tax over the life of the annuity, and it makes it very, very tax efficient. In the early days, most of the money is returned as capital, and so the tax burden is very low on a prescribed annuity. That will change drastically in 2017. So once again, I offer this white paper to anyone who is interested. But today I want to go into this particular case study that we have. If you have any questions, by the way, you can just write them in the window below, in the chat window below. So as we go along, just feel free to write in a question, and I'll be happy to address it at that time. You guys can probably hear that I got a bit of a cold, so excuse me. I'm probably going to cough a couple of times. I apologize profusely. Don't know how I managed to get a summer cold, but we're gonna forge on through this, and I hope to get you some good information here in the next 20 minutes or so. So as I say, National Best, my team at National Best is in the management of protecting wealth for business owners. And in this particular case, what we're going to do is we're going to just do a little bit of a brief case study on what it looks like in case of a business owner. Of course, the lawyers have to have their way first. So here's a little disclosure, which says that any information here should not be acted upon, of course, without professional advice from an advisor, and particularly an accountant. So please read through this very quickly and carefully. Excuse me. So when we're talking about a business owner, we're talking about a successful business owner. We'll call him Joe Business, or it could be Jane Business. It doesn't really matter. But they've spent the last 15 years or so working on their business, and they've produced a very good. They produced a very good business. It's very profitable. They could be a manufacturer, could be a wholesaler or a retailer, even a professional corporation like a doctor or a dentist or an engineer. Any corporate structure, this particular strategy applies to. So the strategy can work in any of these circumstances. Now, in building up the company, of course, Joe didn't do it alone. He did it step by step. He expanded carefully. He controlled his costs, got a good accountant, hired warehouse managers to look after inventory. He hired a marketing company to help build his brand, grow his client base. He had sales coaches to improve his sales staff, even had a personal coach so that he could stay on track, sort of stick to his business plan. So, Joe's a pretty good guy in terms of a business owner. In fact, he started making a lot of profit because he was a well-run business. And these profits are left over every year because he doesn't need them to operate the company or to pay for his lifestyle. And those are what we call retained earnings. And so retained earnings are what we're focusing on today. So Joe and his family have a pretty nice lifestyle. And he's got happy employees. He's got a health benefits plan for them, and he's got a group savings plan. So year after year, the retained earnings from profit keep growing inside of his operating company. And that's a good thing. And eventually he ends up with $1 million sitting in his opco. And he's kind of teeing this up for retirement. And he's looking to retire in about 10 years. He's 50 years old. And so Joe asks his accountant if they should invest it so it can grow. Well, his accountant's, he's a safe kind of guy. So he says, well, you know what? The safest thing you can invest in is a 10-year GIC. That way you can't lose the money, and you'll have some kind of return at the end of it. So I guess the question becomes, what happens if Joe invests in a 10-year GIC? Well, currently today, a 10-year GIC is yielding about a 2% interest rate. So if we actually compound that return over 10 years, it's about $218,000 is what Joe will make in his operating company. Well, that's not bad given the minimal interest rate. He's kind of keeping up with inflation. But is that what Joe's real return is? Let's see what it actually is after 10 years. Oh, $103,000? That's a big difference. That's less than half of what was expected. So the question becomes, well, why is that? Well, we can thank these folks because they got together a year and a half ago, and they decided that the corporate tax rate on invested retained earnings will be 50.67% tax. Now, why would they do this? Why would they want to tax heavily retained earnings that are invested inside of a corporation? Well, the reason is the government provides the corporate structure so that companies can have a shelter for their business in order to hire employees or purchase services, purchase inventory. In other words, to grow the economy. The government wants us to use corporate structures to grow the economy. They do not want us to use corporate structures simply as a shelter for investing money or investing the retained earnings in the corporation. So it makes sense that they would actively discourage investing of retained earnings. And so in order to do that, they just tax it heavily. So the question becomes, how do you find an umbrella against the taxes that seem to be raining down on us from sort of both levels of government? Not to mention that in his operating company, these particular retained earnings are accessible by creditors. So if Joe were ever sued, then all of that $1 million he's built up over those years is now susceptible to creditor risk as well. So how do we solve these issues? Well, on my team, I have a fantastic tax lawyer named George Craven from Monarch Tax Law. And of course, I'm the founder of National Best Financial Network, and my job is risk management. So together, we would start to get to work on this program. And George would first take a look at the corporate structure. And what George sees is an opportunity to set up a holding corporation and to transfer those retained earnings into a holdco out of the operating company, and that will provide an extra veil of protection against creditors. It's not bulletproof, but it certainly makes it more difficult for creditors to get at that money. The other thing is you can have separate shareholders in the holding corp from the operating corp, so you can income distribute in a more specific way and a more tax efficient way. Another reason is to make sure that your operating corp maintains its qualification as a Canadian-controlled corporation for tax purposes, the $800 capital gains exemption, and that's a very valuable situation to set up. And you've got to make sure you're under a certain value in your operating corporation to make sure you retain those particular attributes. So George would help Joe to set up this structure. He might even suggest to Joe to get a family trust as a further method of tax reduction and tax efficiency, especially if they're going to sell the operating corp someday. But that's a discussion for another time. We don't want to get into that today particularly. Then I step in with my particular expertise, which is in tax-deferred creditor-proof retirement funding. And that's the 3-point strategy that we've developed. This particular strategy is strategy number 2, which we call the variable deposit rate. Really what it means is that Joe is able to deposit into an investment structure, which represents a 10-year investment, tax deferred, but he gets to actually participate in equity index returns. Now, This scares some people because they think, oh no, I don't want to invest in the stock market. I invested in that GIC according to my accountant because I didn't want to lose the money. Well, the beautiful thing about this particular program is that you do get exposure to equity markets and to the upside of those markets, but there's no downside to the plan. There's no way to lose the money. And that's a pretty cool attribute. This particular program is called a Guaranteed Market Index account. That's the actual investment inside of the Universal Life Policy, and it's provided by BMO Life Assurance. Now, again, I'm using BMO as an example in this case because I'm an insurance broker. I have over 15 companies I'm licensed with. Currently, I have 26 I have access to. So what I'm doing here is I'm picking what I think is the perfect situation for Joe, the perfect product for him. Guaranteed Market Index account's a great account to produce this result. So he invests the $1 million. Well, what's the rate of return? That's what everybody wants to know. Well, after back testing this for 30 years, BMO found they were making between a 6 to 8% rate of return. Over the last 18 months, they produced a 6.5% rate of return for the investor inside of the product. No problem, tax deferred. So if we assumed a 7% rate of return as an example, just as an assumption, then the 10-year compound return would leave Joe with $1.829 million inside of his operating corporation. Now, notice below I say tax-free. Well, that's because there's no tax payable. There is no tax payable on this particular product as it grows. Because once again, life insurance is a tax shelter. There's no tax payable on investments inside of permanent life insurance products. The other tax-free portion of it, though, is that Joe can now use the insurance policy as an asset, and he can borrow against it. He either has the ability to guarantee to borrow from the insurance company, and that is guaranteed in the contract. So there's no doubt that he can borrow from the insurance company. So after 10 years, he could borrow the 90% of the cash value, 90% of the 1.8 million could be borrowed out without any questions asked. So that makes it an incredibly flexible product because your money isn't tied up inside of it. There are other programs that are useful for corporate owners to put away retirement funding, such as an individual pension plan, but there the money's tied up and you can't get at it. Here, you have the ability to save the money, keep it in this deferred structure, but still have access to it. In fact, from a third party, most third party lenders, most banks are happy to lend against this particular asset. So it's a fantastic product from that perspective. Now, what if Joe passes away in the 10th year? What happens then? Well, according to the illustration that we produced for this particular presentation, Joe's holding company would receive, assuming that the holding company purchased the insurance, would receive almost $5 million tax-free. Now remember, the holding company was the owner of the policy and is the beneficiary of the policy. However, the vast majority of that money will flow to the shareholders according to Joe's will through the CDA account. There's a small calculation, this net benefit minus the adjusted cost base is what actually flows through. And again, that's something that's going to change come the new rules. So again, I don't want to get into the details of how that's going to change, but needless to say, again, a spectacular estate planning tool for Joe. So the reason that we're really talking about this today is that this particular strategy disappears in January 2017. So we want to make sure that any business owner who has this sort of situation happening, they have the opportunity at least to be able to review this strategy to see if it's appropriate for them and to be able to make that application. And the really tough thing about this is because it is an insurance-based product, someone has to qualify for life insurance. Well, that could be the CEO, or it could be another shareholder, or it could be a key person in the company. It doesn't really matter who the insured is as long as there's a proper insurable interest. But because of the qualification, we can't wait until November or December to apply for this particular strategy. It has to be applied for this summer. So before the end of August is when these applications should be put into the insurance companies. If you've ever gotten insurance yourself personally, you know that it takes 2 to 3, sometimes 5 to 6 weeks for underwriters to fully underwrite and produce the policy in force. Well, with these large policies, it's not a 2 to 3 week process. It's a 2 to 3 month process. So as I say, it's important to make sure that these particular strategies are made use of. If they're going to be made use of, that they should be applied for as quickly as possible. So again, if you have clients, or if you are a potential client, and you think this might be a valuable strategy for you, certainly, call me now. I'm happy to help out. I'm happy to provide information. Again, if you want more details regarding the changes and the various aspects of those adjustments to the tax law, I can send you a white paper. Happy to do so. And again, I make this point that, yeah, we gave an example of $1 million dump in. It doesn't have to be $1 million. It could be 500,000, 50,000. It could be $10 million. At this point in time, all of those are valid, legitimate possibilities. None of them will be after 2017. The large dump-ins will disappear pretty much, and you'll have to have incremental deposits into this strategy over time, which will increase the cost of the insurance and, again, decrease the amount of money you can shelter inside of these particular policies. So that's the presentation today. I hope it was of value to some of you out there. And if you have any questions, I'm ready to answer them. Oh, if you have any questions, just type them into the chat window down below.
We'll be here for a couple of minutes.